Hi traders, and welcome to another video. In this video we will shed some light on support, resistance and trend lines, or also referred to as SRT. Once these are understood, we will explain the concept of break and retest. Let's go! Support and resistance is one of the most widely used concepts in trading. Strangely enough, everyone seems to have their own idea of how to measure support and resistance levels. Let's take a look at the basics. As mentioned a few times already, the market moves in impulses and pullbacks. Look at the diagram. As you can see, the zigzag pattern is making its way up, so it's a bull market. When price moves up and then pulls back, the highest point reached before it pulled back is now resistance. Resistance levels indicate where sellers are looking to enter and buyers are looking to take profit, also called swing high. When the price continues up again, the lowest point reached before it started to go back up is now support. Support levels indicate where buyers are looking to get in and sellers are taking their profit, also called swing low. In this way, resistance and support are continually formed as price moves up and down over time. In the most basic way, the bounce is how support and resistance is normally traded. The path of least resistance is trading with the trend. Too many traders try to pick the top of the trend or the bottom of the trend to catch the reversal. Unless you have a special strategy to do this, 90% of the time you will get burned. That's why it's widely known amongst traders and maybe even a cliché that the trend is your friend. Or you might even hear traders say, buy low, sell high. What does that even mean? It simply means that we buy in uptrends and sell in downtrends. Buy the dip, for example. This is when price falls towards support, preferably in an uptrend. Or sell the rally. This happens when the price rises towards resistance, preferably in a downtrend. Don't try to buy in a downtrend or sell in an uptrend, unless you have learned a specific strategy to do this. If you stick around long enough, you might learn how. Okay, so here's an example of a chart where we already marked the support and resistance zones for you. Look at how the market repeats itself over and over again. It's almost like a stairway, don't you think? On the left we drew support zones. These are the dips in an uptrend. And on the right we drew the resistance zones. These are the rallies in a downtrend. Remember, buyers buy the dip and sellers sell the rally. Take a minute to look at them, so your brain can take it all in. Okay, let's continue. Trend lines. First of all, a trend line is a diagonal form of support and resistance. It's used to show the direction of the trend and it also supports it. Using them makes it more easy for you to spot if the trend is bullish or bearish. To draw a trend line, you connect the price points with a line. Trend lines are one of the most basic tools of technical analysis. They act as support and resistance levels, but instead of being horizontal, they are diagonal. In generally, the more vertical inclined the trend is, the stronger it is. As you've already learned, an uptrend is a series of higher highs and higher lows, and a downtrend is a series of lower highs and lower lows. When the market is consolidating, however, it's useless to draw a trend line, because the market isn't trending. To have a valid trend line, you need at least 2 connection points. But the more points you can connect, the more valid the trend line will be. You can use trend lines to try and predict future connecting points. By drawing a trend line and connecting 2 points, and then extend the line. It's probable that price then will test the extended trend line again. We'll show you how to draw trend lines and how they are used. However, we don't use trend lines in our strategies that we teach. But of course, everyone is free to do what he or she wants. A small tip, the third touch is the strongest for a bounce. The fourth touch is a 50-50% chance to bounce or break. If you draw a bullish trend line, you will draw it under the Japanese candlestick by connecting the low of the wicks, as you can see on the example. If you draw a bearish trend line, you will draw it above the Japanese candlesticks, connecting the highs of the wicks. Always try to connect as many price points as possible, but try not to cut through price candles. Remember, higher time frame trend lines are more reliable. Never try to force a trend line to fit. If it doesn't fit the chart, then it isn't valid and therefore it's not worth having on your chart. A strong break of a trend line after multiple touches could mean a reversal. If we take the trend line theory one step further and draw a parallel line at the same angle of the uptrend or downtrend, we will have created a channel. No, these channels aren't television channels. They're trend channels, sometimes also called price channels. There are three types of channels: ascending channels or rising channels, creating higher highs and higher lows, and descending channels or falling channels, creating lower highs and lower lows. And of course, horizontal channels, which aren't actually channels, but we know them as consolidations. When constructing a trend channel, both trend lines must be parallel to each other. Traders expect price to bounce between these lines, providing them entry and exit points. As you already know, uptrend lines should be plotted between support troughs, which means that when the market is trending up, the trend line lies below the price action. Logically, downtrend lines should be plotted between resistant peaks, meaning that when the market is trending down, the trend line appears above the price action. This means that the parallel line that we need to draw should be dragged to the most recent high, in case of an uptrend, or to the most recent low, if prices are trending down. Don't forget, when plotting trend lines, you should not be forcing the parallel lines. If they are not matching the price action, then this is not a channel and you should not try to fit them. But of course, waiting for the picture-perfect textbook example won't help you in the real world neither. Because it's gonna be pretty rare to see price action that fits perfectly within two perfect parallel trend lines. In this part of the video, you will learn the classic chart patterns and formations. We won't give them too much attention, but it's good to be aware of them and know they exist. When these patterns are correctly identified, they usually lead to an explosive breakout, so watch out. Remember, our goal is to spot big movements before they happen, so we can ride them out and take the cash. Chart formations or patterns can help us greatly to spot the condition where the price is ready to break out in a certain direction. They can also indicate whether price will continue in its current direction or reverse. Don't worry, we'll give you a neat little cheat sheet to help you remember all these cool patterns. We have two main types of patterns: reversal patterns and continuation patterns. Reversal patterns are mostly seen at the end of a trend, while continuation patterns tell us that price is getting ready for a next move in the direction of the trend. Let's take a look at some examples. Okay, here you see the most used and most important reversal patterns. Maybe it's not a bad idea to take a screenshot. You can also find a lot more patterns on the internet. Maybe you can print them and even hang them on your wall. Okay, so please remember guys, the market is not a software that has been programmed to do things exactly the same every time. All patterns will differ and nothing is ever perfect in the financial markets. So don't bet your life on every pattern you see. Again, it's important when and where you identify these patterns, just as with the other tools and confirmations. Okay, so these are the most common continuation patterns. Personally, we think these are a little more important because these will help you to trade with the trend, not against it. It's good to practice on finding these on your chart and you will be astonished how many there are. Let's explain the concept of break and retest. In a perfect world, support and resistance levels would hold forever. The fact of the matter is that these levels often break. So it's not enough to just play the bounces. You should also know what to do whenever support and resistance levels break. There are two ways to play the break in trading: the aggressive way or the conservative way. The aggressive way to play the breakout is to buy or sell whenever price passes convincingly through a support or resistance zone. We say convincingly because when we choose the aggressive way, we still need to wait for the candle to close below or above resistance. The bigger the candle that breaks the zone, the better. The conservative way is waiting for price to break the support or resistance level and wait for price to come back and test that broken level. We need a clear and evident break before going for the retest. The funny thing about that is that the aggressive trader and the conservative trader will probably have the same entry price. The difference is that the conservative trader has way less risk than the aggressive trader, because the level has definitely been broken convincingly before entering a trade. Waiting for the retest gives us that reassurance that the market is most likely to continue in the direction of the break. So a broken support becomes resistance, and a broken resistance becomes support in this trading method. When we have the confirmation that price isn't getting back through, we can enter in a more safer way. A small disclaimer, this doesn't happen all the time. Retests of broken support and resistance levels do not happen all the time. There will be times that price will just move in one direction and leave you behind. But keep in mind, it's better to miss a trade than to take a loss. Break and retest using trend lines. If we can use a concept like this using horizontal levels, we could also do this with diagonal levels like trend lines. The idea is that you identify an active trend line and you wait for price to break out of it. Sometimes the price will just run away and won't look back. However, if the price trades back to the trend line, we can trade the retest. Of course, just as with other confirmations, we want more than just a retest. Watch what price is telling you. Be careful when trading a trend line break and retest, because a lot of times price goes for a second retest, which could be further than your original stop loss. The steeper the trend line, the higher or lower, depending from the trend direction, the retest will be. Price can also spike through a trend line and going back in. This is called a fake out. A lot of beginning retail traders will place their stops just below or above the trend line, expecting a bounce of the trend line, and of course smart money knows this. So sometimes they drive price through the trend line to grab liquidity, to then just continue the trend. That's why we always need multiple layers of confirmation, or in other words, confluence. Okay, so confluence is where multiple confirmations come together. Confluence trading is when you combine more than one trading technique or analysis to increase your odds of a winning trade. We use multiple trading indicators or tools that give us all the same reading, as a way to confirm the validity of a potential buy or sell signal. Sticking to the topic of the video, we can use support and resistance together with a trend line, for example, or using the Fibonacci tool. By having multiple confirmations, we gain more confidence in our trades and we won't bail out so easily when we experience some drawdown. Confluence can be technical tools or indicators, but it can also be some kind of fundamental confirmation. Another basic confirmation without using indicators can be psychological levels. These are round numbers. Where would you rather buy? 1.15120 or 1.15000? Psychological levels are price levels which are often key levels in Forex, denoted by round numbers. These round numbers frequently act as levels of support and resistance. Psychological support and resistance consistently work because of fundamental human disposition. Human beings value simplicity. From a trading perspective, this means valuing whole numbers. Traders will often call these whole numbers double zeros. Some traders will take it a step further by looking at the numbers directly in the middle of these whole numbers, or the 50s. We like things that are simple, that are easy to process, that are easy to make sense of, and that are easy to understand. We know this was quite a long video, guys. Thank you for your attention, and we'll see you in the next video.